Protecting the future of working families, Teamsters 1932.org.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I am Jeff Barton, and this is The Mortgage Voice. Welcome to the show. And if you're new to the show, thank you for tuning in. We talk about real estate. We talk mostly about mortgages, mortgage programs. We talk world economy, local economy, national events of what we're doing here in order to help you make better decisions about your buying and selling. There are so many ways by which you can be affected, either by the environment. Maybe it rains today and you just were supposed to meet your banker about going over that mortgage and you don't make it. That's a problem. So how is it that you can get the best information to you so that you can make the best informed choices to go out there and buy and sell and do your loan and all that stuff? Well, that's what we try to do on the show. We do it here each and every week. We've been doing it for 10 years, and I thank you very much for listening. Out in the IE, the Inland Empire, San Bernardino, Riverside counties, all of my great friends out there. I have a lot of colleagues that live out in that area, and there have been so many changes. I mean, you think about it from 2008 to today. What is that, 15 years roughly, maybe a little bit more, a little bit less. It is an amazing, amazing journey from being underwater, 75% of the homes out there, to now having huge amounts of equity in most homes. And the biggest question to most people, especially now that the holidays are over and the bills come due, is how can we tap into that equity? We'll try to get to some of that as we move along. A little bit of where we are and how you can get to us if you're not listening to the show today. We are on YouTube, Jeff Barton, The Mortgage Voice. That's a great place to go see the show. That's right. You can see me talk to my guests, and weekly we can, you can also go to the website if you want. It is themortgagevoice.com. You can go there, look and see the show, as well as find out how you get in touch with the guests that come on the show, whether they're loan officers, whether they're working for different lenders or banks, whether they're skilled people in different professions that can help you decorate your house or find out what the coming trends are, or all those kind of things. Anyway, Jeff Barton, The Mortgage Voice, is on YouTube, and of course, themortgagevoice.com is on the internet. The internet itself is always changing and always a bit of a mystery. We driving over here today, listening to a couple of things on NPR. It's about as neutral a radio station that I can get. A lot of it is news. Sure, it's got a particular political bent, but for a lot of it, it's about news. And this news was about no news, meaning most of the news centers here in the Los Angeles, San Bernardino, Southern California areas, San Bernardino, Riverside. The amount of people who are getting laid off in news organizations is huge, whether it's the Los Angeles Times, whether it's a local paper, whether it's CNN, whether it's Fox News, whether it's NPR, for instance. And that is affecting how and what you see and hear. Now you say, why and who cares? Well, financial news is what we talk about on the show all the time. I give you numbers, and these numbers we get off the internet, and we get off the internet from news sites, whether it's Mortgage News Daily, whether it's Housing Wire, whether it's MSN, whether it's, just your general generic Reddit.com. All of these different places have a certain amount of financial news that they report on. For the most part, they are regurgitated, government-issued press releases or reports. There's very few dig down deep, let's figure it out on our own news reporting in the financial area. Well, now that we see that these particular news organizations are laying people off, and we're not talking about a few people, we're talking hundreds of people. LA Times, 11% of the reporters are being let off. That's a big number. And especially on the heels of what happened last year. So this means that we would have to rely more and more on just regurgitating facts or AI. Both of these things are not research, nor do they tend to focus on what is the truth or what isn't the truth. It's a regurgitation of what the government reports are, or AI really is a search for what is most commonly searched for, or what most articles appear and how that information is delivered to you in a quantitative way. So for instance, if you have a cooking show, and there are 500,000 cooking shows out there all talking about making a souffle, if you type in to AI and you want to know about the latest trends, you're going to get what most people are looking at, which is, of course, the souffle. And whether that's true or not, that's how AI works. It works on an algorithm which really generates information to you based on what everybody else is either talking about or asking questions about. So this is not a research tool. Anyway, the financial information that we give, okay, we talk about unemployment. We talk about inflation. We give you the weekly interest rates on loans. We talk about the amount of houses in the market, whether they're going up, whether they're going down. All of this is going to be affected, which means that the information that I give to you, I don't have a research staff, it's just me. So I searched all these different places, find the information, bring it together, and talk to you about it. The interesting thing is, most people would prefer to get their information like that, rather than go out and search for a lot of different areas. I was accused recently of being either naive or ill-informed, or what was the term used? I don't know, it was like misinformed, something like that. And I'm thinking, well, I'm pretty well informed as an adult, and I think there are a lot of people who drive around and listen to these types of radio stations, even if it's KNX in the Los Angeles market or out in the San Bernardino Riverside markets, whatever the news station is. Most people think they're pretty well informed about what's going on, especially because they get most of their information either off TikTok, Facebook, Instagram, one of these social media sites, right? But having been accused of that, I had to really look and see, okay, what is it and how is it affecting not only what I do as a job, but how is it affecting the people I speak to? So as skeptical as I am as a human being, and as cynical as I can be in terms of what information is important or what information isn't important, we still try to deliver a type of show which brings to you information, but at the same time, you know, I'm just a talking head talking about my opinions about what's happening in the world. And I think there's so much of that. However, that is the coming trend, if not has been, or if it has not been the actual trend of what's going on right now. So let's get to the news, quote unquote, and talk a little bit about what the rates are. Okay, 30-year fixed rate, 6.6%. Now, we haven't seen 6.6% on a 30-year fixed rate loan. This is from a Fannie Mae, Freddie Mac product for quite some time. So that's the good news. 15 years at 6.17. FHA is at 6.14. The jumbo is at 7.11, and the 5-1 arm is at 6.24. The 2 years at 4.359. I'll just dot it out there for a few decimal places. And the 10 years at 4.14. Now, as you can see, 1.4 to 3.5 is 20 basis points. So we've gone from a full 100 basis points in spread from the 2 to the 10 to now we're down to 20 basis points. And of course, people are now, and usually that means that, okay, we're probably not going to have a recession if it's been like that. But because we've had this great spread for so long, we are getting the inflation, not the inflation, the recession people talking again. And one of the reasons that I talk like that about that is because of the unemployment situation. We've had a revised number. Again, back to information, who we get it from, how we spread it around, what's retained. Anyway, so the unemployment figures for 2023 were underreported by 400,000. So divide by 10, right? It's about 35, 40,000 people a month if you average it out. That's a big number. That tells certain things about what is going on in the economy as opposed to the rosy picture, the initial numbers came out. Now, if you're among those out there who think conspiracy at every corner, that would mean that, oh my gosh, this must mean that the Democrats are blah, 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 or the Republicans are blah, blah, blah. Well, it doesn't mean any of that. These types of rescissions and these types of amendments to what the information is been going on forever. whenever a report comes out, it always gets amended. That's just kind of the way it is. So in this, what we have in the employment data is something I want to get to in the next section a little bit, just so you can understand what you need to prepare for, and then I'll describe a little bit about what's happening as well. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton. This is The Mortgage Voice. Thanks very much for tuning in, coming to us each and every week to try to get your information on. And in order to do that, you have to know where to get us if, in fact, you can't hear the show the whole time. You can go to themortgagevoice.com. That's the web address if you want to go there and see the guests. You can also go to a number of podcasts that we have. Yeah, we're the podcast crew, too. Daryl, do you have a list of that podcast for me, please?
I have somewhat of a list.
Somewhere?
Yeah, I changed computers, and I did this from, I wrote this down.
Oh, from memory. Oh,
yeah,
that's
in
good.
writing. How many things do you see in handwriting these days? Not much. It's Apple Music Play, Stitcher, Streaker. We've got radio.com, podclips.io, and themortgagevoice.com.
Excellent. Okay, podclips.io. I always plug this place because it's a great place where you can centralize your podcasting needs. You know, if you go to any of these major podcasting sites, thousands and thousands, and you can't really figure out where your stuff is. So you have to search through, listen to. Let me tell you, go to podclips.io. It is the place where you can centralize all of this stuff, especially if you're like me, you like sports, you like lifestyle, you like health, and you like financial news. It's all there. It's a great place, as I said, that you can go to when you have, you know, things that you have to do other than look up where good podcasts are. Podclips.io, place to go. Thank you very much. Again, I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, so talking earlier in the show, we were talking about some of the things that make unemployment, the numbers that come out, somewhat skeptical in the eyes of the people who listen, meaning that you could be cynical and say, oh, this is a ploy by, you know, the current government to sway votes their way, or this is, you know, a way by which they can make you think one thing while at the same time, you know, putting their hand in your pocket and stealing your money. I mean, that's always the way it is with any political argument. I don't care who you're talking about. Unemployment. Okay, so one of the things about unemployment is knowing which sectors of unemployment are affected. If I said to you, okay, the financial sector is affected in this unemployment rate, I would be telling you that people on Wall Street, people at the banks, would be affected, i.e. layoffs and such. Now, that's true. Banks are laying people off, whether it's Bank of America, whether it's Wells Fargo, whether it's Citibank. They are laying people off and have been doing so. One of the reasons that they're doing so over at Bank of America is not exactly what you think. Yes, they're laying people off. However, they are doing a different kind of layoff when it comes to their office space. There have been some dire predictions as to what's going to happen with the commercial market in many major cities. A lot of the local banks, even national banks that hold paper, i.e. they hold the mortgage on these large office buildings, are freaking because they are not, you know, some of these buildings are half empty. And I think that I haven't seen the number nationally. I haven't seen the number locally, whether it's in San Bernardino, Riverside, or even Los Angeles, what they are. But I can tell you that what Bank of America has done over the last 15 years, probably spurred by the financial crisis of 2008. However, for the last 15 years, they've gotten out of 40 million square feet of office space. Now, that is an astounding number. One of the reasons that they did that was, again, because of 2008. But in foresight, the guy that's been there, Brian Moynihan, who is the CEO of Bank of America, has been for quite some time, they have gone to a much different type of mode when it comes to getting people back to the office. Now, we went to the hybrid mode. We went to the exclusively at-home mode. But where are we now in major corporations is that many of them are requiring, I think Chase is one of them, requiring their employees to come back to work. Well, that's not what they're doing at Bank of America. But what they are doing is they've paired office space, and they do require that you come in, let's say, 2-3 times a week, not 5 times a week. But in this model, they have to fire less people because they've gotten rid of so much real estate. 40 million. At one time, they had 100 million square foot of office space. They pared it down to 60 million. Now, 60 million is a lot. I'm not saying it's not. But if you take that amount of money that you're spending on rent for 40 million square feet per month, and you plow that back into human resources, i.e., let's develop a different way by which you can still come to work, still work at home, and share office space. You know, we had WeWork. Everybody knows what WeWork is, right? The guy that ran WeWork was supposed to be this real innovative hybrid. Let's all do this together, rent office space from a larger space. They've gone bankrupt, by the way. Now, that guy's a billionaire, but the company's gone bankrupt. So what Bank of America did is say, hey, look, you have to sign up for the office space the days you want to come in, i.e. it's like a hotel. And so consequently, the name for this type of, I want to make an appointment or reserve office space for me when I come to work is called hoteling. Yes, hoteling, that's right. And I read about this recently, and it's interesting. So you go, you sign up. I'm going to come in Tuesday. I need the office space from 8 in the morning till 5 in the afternoon, and your office is booked. So you go into a generic type office and work in the office all day long. It's an interesting way, but what made it possible was the fact that they unloaded so much office space. Now, there are a lot of offices that are looking to do the same at the same time. Now, one of the bad things and why they say commercial industry this year, commercial office space, commercial buildings are in for a horrible year is because when interest rates were 3%, 4%, a lot of these buildings in the commercial space went and refied at those lower rates, which allowed them to be able to obviously pay for much cheaper rent and be able to purchase either office space or leases at that particular percentage. Now, we are, 3 to 5 years later, those same office spaces, because the lease is under this mortgage, and that mortgage in the commercial sector is only available for 3 to 5 years. It's not like a 30-year mortgage you're going to get for your house. So what happens today is because interest rates are what they are. And what are they? That's right. For commercial, they're probably like 8 to 10%. So this means that you're going to go from a 3 to 4% interest rate to an 8 to 10% interest rate on the same amount of money or less amount of money. So there's a guy, Howard Lutnick of Cantor Fitzgerald, really calling for just one of the worst years and probably, what did he call it? He said it's a, okay, I'll just give you the numbers. $700 billion to $1 trillion in defaulted loans on commercial loans coming due this year. Those are big numbers. If you get $700 billion to $1 trillion that goes into default, what's this going to do to the banking system? I mean, what is the U.S. GDP? What is the banking sector? I mean, when we look at year-end numbers, we don't pro forma out what this is. This is why these banks that hold this paper are going to be looking either for bailout or to be purchased. And in that type of market, the Fed, which everybody is still wondering what the Fed is going to do, let's say the Fed was to lower their particular interest rates in order to help these people out and get lower-turned mortgages on their commercial space. That would be a way to be able to forestall some of this stuff. But it just doesn't look like it's going to happen because the Fed is so laser, they're focused on inflation, inflation, inflation. And I had a list of all of the Fed names, and I was going to read them just because you have no idea who these people are, who are deciding the fate of a lot of this stuff way out of your control. And really, who are they listening to? Where are they getting their information? And yeah, it's very, very interesting stuff. Okay, let's just get to a few news to use sections. I'll just ramble them off. Okay, let's see. Oh, yes, the commission copycat lawsuits coming to a realtor and a real estate company near you. They've moved to California and Seattle. There are 4 or 5 different companies: Vanguard, Twin Oaks, Windermere, Rapis, Dara, Fox, Realty One. All of these have been included in lawsuits about the real estate commissions. Yes, and they're coming to Southern California too. But one thing I can tell you, and I'm a member of all these boards of realtors as well as the National Association of Realtors, nobody's talking about it. So all of these decisions that are being making that are going to affect your ability to get representation, nobody's talking about it. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us each and every week as we bring to you news, items that you might be able to use. We talk about mortgages. We talk about real estate. We talk about things that affect your decision making. There's so much noise out there. There's so much going on in everybody's world. If you're tied into the internet, if you're tied into social media, if you're on your phone all day long, I feel for you because I'm right there with you. Now, I've been doing this kind of business for a long, long time, and yet at every turn there's something new. There's something I don't know. There's something I have to figure out. Well, this is the place where you can go to let us help you figure out what's going on for your mortgage, right? We bring guests on the show. They talk about programs. Maybe you've got some dings on your credit. Maybe you've got some challenges to prove income. There are a number of programs for you. We talk about the non-QM space all the time, and non-QM simply means that they're not insured or not purchased by Freddie Mac or Fannie Mae. Those are the two quasi-huge government agencies that buy most of the conforming loans in the U.S. The non-QM space, they are funded, and those loans are bought and sold by a number of other different non-governments, so their particular criteria for getting that loan is different. They do have the same basic rules, but documentation on these loans, like bank statement loans, whether they're 12 or 24, I-10 loans, which is a business type loan, business bank statement loans, whether it's foreign citizen type loans, all kinds of different loan products for you to think about in that space. Yes, they're more expensive, but they do allow you to give less documentation in order to get approved for that loan. Credit scores are always important on any transaction when it has to do with lending or borrowing. In the non-QM space, you can have a 740 FICO score, and that would be considered A paper. Anything under 700 would not be considered A paper, and you're going to pay more. It would be the same if I was to tell you about conventional loans, 30-year fixed-rate loans. If you have a great FICO score, and the FICO score of Fair Isaac is really your credit score, the 3 credit bureaus, and how they report you and what you pay on each and every month really affects the ability to get the best rate out there. Most of the rates that we quote on this show are for the best possible credit score. However, FHA doesn't really care about your credit score. They're going to give you the best rate possible, period. Now, you can have a down to a 500 credit score and get a loan with FHA. One of the things that FHA does is, and they're looking to look at this rule, by the way, I just read that today. They charge you a mortgage interest premium every month, every year for the life of the loan. Now, the thing that they're looking to look at, you can't say that. What they're trying to do is take that information and say, maybe we shouldn't be charging for the life of the loan, because not until 7 or 8 years ago did they start doing that. Prior to the mortgage meltdown in 2008, all of the lenders out there who did FHA loans would charge you mortgage interest, not private mortgage interest, but they would charge you mortgage interest until you were at 79% of value, loan to value. And if you had 20% equity in the property, you could apply and get rid of the mortgage insurance. Well, they did away with that because they found that obviously the mortgage interest that they would charge you wasn't covering the losses they were incurring, especially back in those days when, you know, anybody could get a loan if you just signed your name, and that was a problem. So they upped the yearly to make it the life of the loan. Well, they're looking at redoing that. So be that as it may, they haven't really decided what they're going to do that, and knowing FHA, it's going to take them a year or two to do that, but it is something to think about. Those particular aspects of the loan in FHA that doesn't care so much about your credit, you can get the best loan rate, but again, it's going to charge you PMI to begin with. Okay, so thanks very much. Once again, I am Jeff Barton. This is the Mortgage Voice, and I've been doing this for quite some time, and I wanted to get to a couple things. I usually pull out the list. You know, there's a bunch of lists in any business that'll say, hey, you know what, and anybody who's too young won't remember the David Letterman top 10 list, but we kind of do that too, in that we will bring up the number of cities that are this, or the number of states that are good to move in if you're retiring, and those kind of things. Well, I have two lists here, and they kind of go hand in hand. One of them is the hottest housing markets in 2024, as told to us by Zillow's prediction. Now, Zillow, interesting company. Zillow, a year and a half, two, well, maybe a little bit longer than that, had a company which was part of Zillow, which would give you a Zestimate, i.e. the estimate on your home, and they would buy your home for whatever the estimate said. Because they had a model that said if you do that, fix it up, you can resell it for X percent, and the company Zillow would make more money. Well, that particular model fell flat in his face, and Zillow got out of that business. Well, they're always in the predictive business because there's no liability in that. They can say, hey, we predict that this is what's going to happen. So take that with a grain of salt that it is, but here is the housing market 2024 hottest markets according to Zillow. Number 10, Tampa Bay, Florida. I like Tampa Bay. When I was a kid in 1964, the first time I went to Tampa Bay, and it was a backwater, I can't tell you. I mean, there weren't snakes in the street, but there could have been, you know. I mean, now granted, everybody looks at those old video and old shots of the time back in the early 60s, and yes, it was sleepy, and they had those weird-looking long cars with the big trunks. Yeah, that was all true, but Tampa Bay was one of those places. Anyway, Orlando, Florida is number 9. Cleveland, Ohio is number 8. Charlotte, North Carolina is number 7. Atlanta, Providence, Indianapolis, Columbus, Cincinnati, and number 1 on the list of the hottest markets, according to Zillow, is Buffalo, New York. Now, you may think all these cities are great, but there's nothing out in California, and you would be right. NPR had it today. Guess what? People are leaving California more than they're coming to California. We did an expose on this, probably on this show a month and a half, 2 months ago, talking about the numbers of people leaving California, the numbers of people coming to California, and it's not as lopsided as you might think. I think there were, let's just say there were 100,000 people last year in 2 years ago, 2022, that went from California to Texas. Well, there were 49,000 who came from that part of the world to California. So the net was, 52,000 that was lost to Texas. So it's not as bad, but, you know, that is kind of the way it is. So if you're in any of these areas, just understand that it's pretty good. I mean, some of these areas, no, they're not California, but hey, I've been to Buffalo. It's cold, and there's a lot of snow right now. Other than that, it's a great place to go. Let's see. On the flip side, if you're looking at likely homes to plunge in price in 2024, okay? Likely homes, likely cities where home prices will plunge, i.e. they will go down. The likeliest cities in the U.S., and I have them right here, top 5, okay? Letterman would love me on this segment. Okay, number 5 is Palm Bay, Melbourne, Florida. That's number 5. A lot of these are in the South, as you can imagine. West Palm Beach, Boca Raton, that's another area. That's number 4. Number 3 is Tampa Bay, another. You see, Tampa's on 2 lists. Go figure, okay? Well, that's the internet for you. Daytona, Florida, that's another place that they predict prices will go down. And the number 1 places, which I find really kind of surprising, is the Atlanta, Sandy Springs, Roswell, Georgia market. Now, I love Atlanta. I've been there a lot in the last 2 years. There's so much building going on there. There are cranes everywhere. Now, Atlanta's a huge place, right? Any big city is going to have many, many different areas, many different places. It could be that one particular section, if that particular city, maybe the prices are going down. But more people are moving to Atlanta than I would say moving almost any city in the South. Anyway, that's my top 10 list. 1, 2, thank you very much for tuning in. Really appreciate that, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We bring to you each and every week the news to use and a number of different items that can help you with your decision-making process when it comes to what kind of loan am I going to get, where am I going to get it, where is the real estate, are we going to have better prices? All of this is upcoming and great guests to talk about that. But before I do, if you want to see this show, go to YouTube, Jeff Barton, the Mortgage Voice. We have hundreds of shows there, so you can see sort of a perspective, a week by week, what happens, get a real feel for what's going on in the marketplace according to me. Now, I've been in the business quite a long time. I really know how to look at things and say, okay, I think this is the way it's going, and I certainly try to give an explanation as to things that you need to know so that you can make the best informed decisions when it comes to your mortgage, as well as not be too overexcited about what's going on in the marketplace. Being what it is, the internet makes people either scared or mad, and those are the two things that keep people coming back. I don't try to do that, just trying to help you out, give you some information. In regards to that, we bring to the show many different types of people, account executives from different major lenders and mortgage companies. Celia Rios, who's been on the show several times, joins us again from Ameritrust Mortgage. Sorry, I couldn't quite get that up, but she joins us now. Celia, thanks very much for coming on the show.
Thank you for having me. I always enjoy our time together.
I love having you on. It's spontaneous, and you have a lot of information. Been in the business a long time, and you really can see what's going on and what products are or are not working right now in the marketplace.
Well, I appreciate that. Yeah, I
Sure.
think you and I have been in it for so long that we see the patterns, right?
Yeah.
And we don't get scared. And I love how you said that bit about the internet news. I mean, I feel like all of that has been such a fear monger for many years now.
No, it is. It is. I mean, if you're buying a house, it's going to be scary enough. You don't need to have people hype up about whether you're going to lose your job, about whether inflation's going to eat into it, whether there's a war that's going to bomb your house. You don't need any of this stuff. What you need to do is focus on solutions. Tell us what's popular right now. What's some of the loans that you have at Ameritrust might be able to help some of these people?
Well, we do offer the whole gamut of loans. We do anywhere from the government agency loans to what we call the non-QM for your self-employed. We also offer for ITN numbers because we have a lot of people that are in the process, because you know how hard it is to get.
Yes.
You could go into the process. It could take you, 20 years, unfortunately, here. So you have an ITN number. You're doing everything legally and right, but, you want to buy something.
Right.
So we do offer programs for that. That seems to really be my niche right now, and we offer lot loans, believe it or not. And this company is really good in the aspect that we don't put all of our eggs in one basket. We have more than 10 investors in that particular pool of non-QM.
Okay.
Good to know. For example, like your investor debt, like you're an investor and you want to do the DSCR, debt service type, which means we don't ask for income or anything like that. We're just going to look at the property, and if you have enough rent that covers principal, interest, taxes, and insurance, that's it. We're okay with that. And it's about 30% down. You need about 30% equity in those types of loans. But those are really kind of that, and the ITNs are really going. I really think we're at the end of our winter, I call it. Right. For the game of loans.
Right. The game of law, that's very good. Clever. That's pretty good. I never heard that one before. I got to keep that.
I use it all the time. I'm like, okay, remember winter's coming, and now it's here. And we're at the end of it. I really do believe we're at the end of it. it's reciprocal. I mean, people go back,
Sure.
and if you look at it, I tell people that all the time. I go, it wasn't too long ago. I mean, you might think it was long ago. 17.99 was a fixed rate.
Well, yeah, I think that's true. But I think for a lot of people who are, let's say, millennials trying to buy their house for the first time, which by that whole group is buying homes later than their previous couple of groups, i.e. in their 20s, we were buying homes from baby boomer generation. But this particular group, no, they're buying homes in their late 30s, early 40s. So it's a little bit different, and they approach it quite a bit differently. Do you find... What's happening with is it more purchase? Because I don't think there's been a refinance done in quite some time. Do you guys finding any refinance?
Actually, I have.
Okay.
I actually have done a couple refinances because they're going to be selling, so they really don't care what the rate is, and they're taking it out to purchase another home, to purchase, in fact, Alma, one of my AEs.
Yes. Of course.
She's going to become a grandmother, so that's what she did. She actually refinanced to purchase another home to be closer to her new grandbaby coming due next month.
Oh,
so,
that's nice.
Life happens.
Yep.
Life will continue, and that's what this whole scare tactic. And that's and I have clients that have come to me that I give to my brokers because I no longer do the retail portion of it. But they'll come to me and they're just like, I can't afford. And I said, okay, let's just focus. What is it that you want to do? Let's set your goals, and we'll work, and we'll get there. And it is definitely manageable. I'm so tired of, you can't afford it, my kids can't afford it. And I said, you know what? I remember in the 80s when I bought my first place. I was like, you can't afford to buy. And I'm like, guess what? I was able to do it.
Well, I think, right, that particular viewpoint is, I share that. And I think there are any number, especially where we're in a very silly season where we're going to be hyped up by the end of the world versus the other side saying it's the end of the world because of you. And it just makes people on edge, and to be able to trust is one of the things that I think when you have experience doing something like you have doing mortgages for all these years, you know what you're talking about. So like you say, focusing, get set on some simple things. What do you make? What's your credit score? What are your bills? What are you looking at? The type of things that are simple and controllable by anybody, because all it takes is just to sit down with somebody with experience to be able to know, hey, I got this. And I think that's what you're talking about.
Well, what's really interesting on that same note is, I always tell, like I had a friend of mine, she's like, I'm moving out of California. I can't believe it. My kids can't afford to buy here. And I kind of looked at her and I said, well, hold on a second. What is it that you want them to buy?
Mm-hmm.
$2 million house, $1 million house? I said, if you look at immigrants, any immigrants, they pull their money together and they buy a fourplex.
Right.
And they all go into the 3-bedroom fourplex and they work and they build and build and build. The problem is we're instant gratification. We want it now. We want it perfect. We want the top of the line of everything. And once you get to that house and you're in that house and it's all been given to you and it's perfect, you're miserable because you never earned it.
You're right. I mean, you're preaching to the choir here. I think earning it and being able to do it. I think one of the things about this particular market is the entry-level stuff is gone. So you really have to ferret it out. You have to share expenses. You have to go in with somebody else in order to buy it. Or you have to have very friendly and nice parents who will lend you the money to make up for the difference of the money you don't have for the down payment. I think that's one of the issues, and I think that has to do with a lot of what's going on in the market. It has been going on since '08, but even before then, they're just not building like they used to build.
No. Mm-mm. Well, I just came back from Austin.
Okay. Yeah. Tell me about Austin.
Austin is building.
Yeah.
But it's really kind of interesting. It's I went in and looked at some of these condos that are brand new.
Uh-huh.
It was 400 square foot studio for $350,000.
Oh, whoa.
Okay. So $350,000. I'm like, okay, it's entry level. Let's see. We'll look at it.
Right.
But
$800 a square foot. Right.
Yeah, but I'm better off renting because I have no control over what those HOAs are going to be. And that, to me, is a hot button right now. Why I'd rather have an SFR and not HOAs because insurance is going up. There's no control over that.
Right.
I have no control over. So, they have several pools, everything. And to me, those are dollar signs that I see. Like,
Right.
like a millennium who wants everything perfect is going to be like, oh, luxurious resort. And I'm thinking it's unaffordability down the road.
Right. No, I totally agree with you. I like your attitude about how to do that. And in Austin, they're building 35,000 brand new homes. That's another area in the country where there's more housing being built there than almost any place in the country. So that's a good thing for people who want to move there. It should keep
but there's also an exodus. There's an exodus.
I see. Okay.
And that's what we also have to look at trends, right? Because I went there because I have an investor that wants to purchase. And I
see.
You want to purchase? It's Tennessee now.
Okay.
Austin
Where Nashville? Nashville's really expensive.
No. Kind of out like Georgetown, outside.
My sister lived in Jackson, which is the other end of the state, which was nice. But this is going back 40 years. But still, I know a little bit about Tennessee.
That is where people have been moving to. And that's it.
Right.
And if you kind of look at where it's at, okay, so where's the next place going to be? So that's my whole point is what made Austin so famous was the baby boomers because they didn't want to own vineyards. They didn't want to go golfing. They loved music.
Okay. All right. Hey, very good. Listen, we're up against it. This is terrible. We should spend another hour talking about what's going on in the marketplace.
I know. I'm so sorry.
No, that's good. No, you're excellent. Okay. So, Celia, tell people how they can get in touch with you, especially if they want to know more about loans over at Ameritrust.
949-903-2881, Celia Rios. Celia Rios at AmeritrustTPO.com. And whether it's, retail or not, direct or not, any questions, just call me because truly what I believe I'm here for is just to help as Jeff.
Excellent. Thank you very much, Celia. I really appreciate you coming on the show once again.
Thank you.
Thank you. That's Celia Rios from Ameritrust Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis for the last 10 years. That's right, 10 years. You think about that for a second. Where were you 10 years ago? What were you doing? Did you own a house then? Did you get a mortgage then? Why not? Well, I can say that to you right now. If you're still on the fence or it's just new and you haven't heard that kind of explanation before, getting in the game, okay, that's what we could call this particular segment. Joining us now is Charles Giscombe, who we often talk about this in terms of either the non-QM, traditional loans, or just being able to say, hey, you know what? I'm a homeowner. I can build equity. Charles, how are you? Thanks for coming on.
Jeff, always a pleasure. Thanks for having me again.
Thank you. Thank you very much. Okay, let's just talk basic, needs. Everybody needs some place to live. I had some guests on earlier in the show, talked about renting in some cities is the best way to go. Rather than trying to get into a condo situation because they didn't like the HOA, they didn't want to pay more and not know or have control over that. What's your feeling on condos? What's your feeling on that type of shelter? Do you think that's a good deal for people to get into something like that, or would you wait for a single-family residence?
You know what? Jeff, it's all about what tickles your fancy.
Mm-hmm.
Honestly, a lot of people like condo living, high-rise living. It takes less effort to take care of. A lot of times there's a level of security that is there, especially if you're in a concierge building. As far as maintenance and stuff is concerned, usually there's somebody on staff to take care of stuff like that. So it depends on that. If you want the privacy of a single-family residence, well, obviously, you have your own space, your own yard. If you have acreage, not so closed in and surrounded. That does take on a lot more liability in regards to groundskeeping and different things of that nature. So it all is based upon the person and what they're comfortable with. If they don't mind being in a closed space with other individuals on top of one another, if they're looking for the amenities and the security and the concierge service, or if you're looking for, hey, listen, I want my own space to be by myself. Any one of those things is great by us, and we like to find financing for all of those things. Whatever your needs are. I have a group out in Atlanta. That's all they want to do, Jeff, is find concierge buildings, high-rise condos. That's all they want to buy because after a while, you can start Airbnb-ing those things, and it's a great money maker for individuals from an investment standpoint.
Interesting. And you know what? Some of the things that you bring to us are great because hadn't even thought of that particular angle of it. Of course, the single family market has always been a target for corporations, hedge funds, BlackRock, Arrive, whoever is going to be doing that because obviously renting those out is a good moneymaker. But for the high-end concierge type building, I hadn't thought about that. That's really an interesting way to look at it.
Absolutely. I mean, because you have to think about it. You know, having multiple properties, single-family residences, especially if they're, homes, there's a lot of upkeep. But you can
Right.
imagine that if you owned a lot of units in different concierge buildings, how, especially downtown areas, metropolitan areas, how that could be a desirable type of property for an individual who's going to be in and out, who wants to run downtown and intermingle, go shopping, who has business in those particular places. Those type of buildings add that kind of, that's a perspective that a lot of people need. They're like, hey, listen, it fits all the needs. I get to get in and get out. I can be in the mix of things, and there's not too much upkeep. So there's a lot of groups that are focusing on those type of properties, even those type of buildings as well as investments, because you can cash in. And a lot of the non-QM companies and stated loan programs have actual short-term rental products and programs and divisions just for properties like that, for sure.
Oh, that's interesting. Again, another light bulb goes off in my head just thinking about, well, if you're a first-time home buyer, somebody that's trying to get into a market, maybe the single-family homes are just too expensive. This might be the better way to go, either on a rental side or on a purchase side, just because it's going to be cheaper. But again, you're buying into equity. Not buying into equity, but you're buying for being able to get equity into the property. The only thing I know about those particular places is you've got fixed costs in your mortgage, obviously, but you've also got HOA. How do you look at HOA? How does a lender look at HOA when you're figuring on monthly the debt-to-income ratios?
It's a part of the cost. You have to include that in your monthly payments and bills. Some HOAs are higher, especially the amenity buildings that we talked about
Right.
have a higher HOA. At the end of the day, there are some pros and cons in regards to dealing with HOA. But in most cases, if you can get to that, get that type of property, Jeff, it's great. And we also lend Malibu Funding as well as United Security Financial. We also have different programs and products that allow us to do non-warrantable condos.
Right.
Those are the condos that have more of an investor population as opposed to an owner occupancy occupant.
Explain a little bit about what non-warrantable means, because people hear that and they go, I don't even know what that is.
Absolutely. So a non-warrantable condo is a condo that doesn't meet the requirements of a traditional loan. So for a conventional loan or FHA loan, you have to have a certain amount of owner occupancy in that building. It has to be an investment ratio, which is a lot higher with owner occupied as opposed to investors. Buildings that have a high saturation of investors on current times, they call them non-warrantable. So they're not warrantable condos that can be insured the same way that other condos can be that are more traditional based. So in that case, you need a lender who has thick skin or who has a comfortability with these type of properties and understanding what it means for the HOA for it to be non-warrantable. It means it can't be insured that way. So if a investor has comfort with that, they will consider and take non-warrantable condos into their portfolio. We have a lot of those individual investors or hedge funds and groups that don't mind those particular type of properties. So if anybody's interested in you want to get a condo and it comes back and turns out to be non-warrantable, don't fear. We have lenders and banks that we utilize that will allow you to finance those properties.
Now, in that type of loan, is it a regular conventional loan, or is this a specialty type of loan? Is it a non-QM loan? What kind of loan is it?
Yeah, well, the more that I do, it's a non-QM loan.
Okay.
It's a non-QM program that you'll get into. It just makes it more lenient, okay, for the buyer to get in, because at the end of the day, these are properties, great properties, in great buildings, great locations, It just means that a lot of times when the builder got it done, it might have been in a place where a lot of investors wanted to purchase multiple units for the very things we talked about earlier, to rent them out. Obviously, those rental situations bring a lot of money in, especially in a place like Vegas or Miami. Places like that where
Right.
you have these type of buildings, there might be a lot of investors that come in nationally, domestically, and internationally who want to place their money somewhere and buy some property. So they may buy these buildings up floors at a time. You see different investors coming from different places to buy these. Those are considered non-warrantable, and so therefore you have to have a specific type of lending, usually in a non-QM realm, that will allow you to purchase those type of properties.
Okay, you mentioned Las Vegas. I want to talk about that for a second. There's a baseball team coming, new baseball team going to come,
Beautiful.
big stadium, right? So now you've
Absolutely.
got Las Vegas seen more as a national city rather than a vacation spot for people who just want to go out and get crazy. How does that change the mindset of the people that live there or the property values of the people who own?
Well, I'll tell you, your values are going to go up.
Right.
They're building and building and building in Las Vegas because they're preparing for the baseball team that's coming. You have to remember something when you think about it. Las Vegas has come, and there's championship hockey.
Yep.
There's football. There's
Yep.
NFL, right? There's going to be baseball there. There'll be basketball soon. There'll be every major sport will be there in Las Vegas. So you have to look at that. It's not just going to be a place where people come to have a good time and get out of. Now, people are going to understand the value that those sports teams and all the new development bring. It brings great value in property. So there's a lot of people purchasing now. There's a lot of stuff going on building. So it's a great place and a great market for individuals to get in. And like I said before, we are so comfortable in Vegas being a non-warrantable kind of state. At the end of the day, you can buy those type of properties because they're going to increase in value and equity as well.
Excellent. Hey, listen, we're up against it. You want to shout out a way by which people can reach you in
Absolutely. You
Appreciate
can
it.
reach me at that good old Nevada 702 number, 702-328-5191. Again, 702-328-5191. You can also reach me at cgiscombe at usfwholesale.net. That's cgiscombe at usfwholesale.net.
Excellent. Charles, always love it. I love talking to you. You're interesting. Plus, you got a lot of answers and information for people who just don't know. And there's so many of us out there. So I appreciate you coming on.
Jeff, thanks for having me. Always a pleasure, my friend.
Thank you very much. That's Charles Giscombe from USF. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Get all the facts, all you need to know on KCAA Radio.
And now, the voices of KCAA with an exciting announcement.
Want to hear NBC News or KCAA anywhere you go? Well, now there's an app for that.
KCAA is celebrating 25 years and our silver anniversary with a brand new app.
The new KCAA app is